Yeah. In this session, let's start looking at this concept of leverage, which is another important function which a finance manager in a company is well behind. He is something. He will be always observing uh, what is the leverage, and based on that, some kind of decisions need to be taken. Just like capital budgeting or the sources of capital and what is the cost of capital, looking at what portion of the capital is in the form of debt and what portion should be in the form of equity. And as a definition, when we use the word leverage, wherever we use this word leverage, it means it's the usage of some fixed costs within the business. The fixed costs could be in the form of interest. From a company standpoint, whether it makes a profit or not, it has to pay an interest to its lenders. That's one of the fixed costs for the company. Whereas the other side of the fixed costs could be the operations related fixed costs. Let's say I have purchased a machine. Whether I produce anything or not, there is a cost that is incurred. Right? Even if I don't produce even a single good using that machine, the cost of the machine is a headache to the company. So they are all like fixed costs. So there could be two types of fixed costs from a company standpoint. One is from an operations perspective. From an operations perspective, whenever we use the word fixed cost, it's more like it has nothing to do with the quantity of output produced. Let's say I have taken a building on rent. Whether I have whether I have business or not, I have to pay the rent for the building. Those are all a part of my operations fixed costs. And similarly, if I take a loan, whether my business runs or not, I have to pay an interest on that. So, from a company standpoint, what are those components of fixed costs that are existing? And that is what we say that is the amount of leverage the company is having. Apart from just looking at debt and equity composition, we will look at in broad terms the composition of the fixed costs as a part of the business. And it is good also to a certain extent. As long as the fixed costs are there to a certain extent, it is good for the company. But exceeding a certain extent, it it bounces very badly with the company. Now, why? Probably we have seen earlier also when we were discussing on cost of capital, the cost of debt for the company was much cheaper than cost of preferred stock, and it is much cheaper compared to cost of equity. So cost of debt is much cheaper for a company, which cost of debt is nothing but interest. Compared to the dividend, the debt is much cheaper. I can raise a loan at a much lesser rate of interest than the proportion of a dividend that I have to pay to my investors. Right? Partnership is always more expensive compared to taking a loan. That's the reason people prefer more of a debt wherever they can get it. So leverage is beneficial from that standpoint. Even if I have to pay some fixed amount every year, that quantity is much lesser than the expectation of the equity investor. The same way, probably if I had taken a building on a rental purpose, right? Probably if I had manufactured a big volume, if my revenues were very high, the cost, the per unit cost associated with that building rental is a very small value compared to if my per unit compared to if my revenues were much lesser, then per unit cost of the building rental looks much heavier. So basically there is an advantage associated with the fixed cost, there is a disadvantage also associated with the fixed cost. To what extent company makes a balance, strikes a balance between these two, is the key intention of this particular chapter. How do we look at that particular aspect? And for a company, if at all any leverage exists, it plays with the risk, because if there is a debt, there is a chance of bankruptcy, right? The higher the debt, the higher the interest I have to pay, and probably one bad year, if I'm not able to pay the interest on time, there is a scope for bankruptcy coming into picture. But in case of equity, there is no question of bankruptcy, because at the max, the equity investor cannot demand anything from the company, because it's a risk that he has taken, and whatever the return he gets, he has to enjoy it. It could be a zero, it could be a 200%. So he has to be prepared from both those aspects. Whereas in case of debt, that's not the case. It's a mandatory to pay, right? So from that standpoint, the company's risk actually increases if it has a larger amount of fixed costs as a proportion of the total, as a proportion of the total composition. If the fixed costs of a company are very, very high, one bad year, 2 bad years. Very recently, we have seen a lot of companies filing for bankruptcies. One of the biggest investment banking firms and all, they filed for bankruptcy in the last few years. The simple reason being the proportion of fixed costs as a proportion of their total portfolio. If the fixed costs are much higher, as long as the performance of the company is really good, as long as the economy is really good, they will fetch you extraordinary returns. Your profitabilities are going to mount up like anything. Let me just demonstrate that aspect to you. Let's say we'll talk about two companies which where both of them have made a sales of 100 only, right? 100 million is the sales which both these companies have made, and let me say they have sold some 10 units each at 10 million. They have produced 10 million 10 units, and they sold each unit at 10 million. Now probably for this first company, they have entirely outsourced, and their variable cost, let me assume that it is around 6 million. So 6 million per unit it has costed them, and their variable cost is 60 million. And for this company, let me assume that their variable cost is only 30 million. They had some fixed, they have produced a very extraordinary machine, they have purchased a very extraordinary machine, because of which per unit cost for them, let me assume that it costs only overall 30 million. And let me say the fixed costs for this company are 0, whereas the fixed costs for this company are another 30. So overall the total cost for both of them is 60 only. Total cost for both of them is 60. So probably if I say profit before tax or profit before interest and tax, so for both of them it is 40 only, right? For both of them this is 40 itself, profit before interest and tax. Now let's say this company doesn't have any loan, right? No loan. So interest, I'll take it as 0. And let's say for this company the interest is another 10 million, right? So finally the profit, and let's say tax, profit before tax, it is 40 for this company, whereas it is 30 for this company. And let's say tax, for simplicity purpose, we'll take it as 50%. 50% of this amount just for simplicity. So tax is 20 million here and probably 15 million here. So the final profit, let's say, is around 20 million here, whereas it is 15 million here. This is the typical structure for both the companies. Now let me say a sales is increased by 1 unit. For both the companies, they are increasing the sales by 1 unit and they are not disturbing anything else. So 11 units overall. So if it is 11 units, right? So if it is 11 units, what will happen for both the companies? The sales will increase to 110. Even for this company, it will increase to 110. And because the sales have gone up by 10%, I am assuming that the variable cost also is going up by 10%. Okay. So these two have gone up like this. Variable costs have gone up, but fixed costs will not change. For one extra unit purchase or producing, the fixed cost is fixed. So the fixed cost is not changing in this case. Fixed cost not changing. So even this is what is happening to your EBIT. Now look at what is the increase in the EBIT here. Probably there is an increase of 10%. From 40 to 44, there is an increase of 10%. Whereas what happened to this company, it has increased to 47. From 40, it has increased to 47, which means almost 17-18% was the increase. So the profitability of the company has gone up when it has used fixed costs. With one additional unit, with the production of one additional unit and with the sales of one additional unit, it is able to increase its profit. And for example, now let's continue with the interest. Even the companies, the interest may not change because the first company did not borrow at all, whereas the second company has an interest of this much. So the EBT part is like this. So probably the tax part is like this. And look at the final profit after tax. From 20, this has gone to 22, 10% increase. But from 15, this has gone to 18.5. So what is the increase? 18.5 minus 15 divided by 15. So there is an increase of 23.3%. If your sales has gone up by 10%, 1 unit extra, which is from 10 units, they have made it 11 units, which means there was an increase of 10%. If the sales has gone from 100 to 110, right, your final profit has actually increased by 23.3%. That is the benefit of the fixed costs in the business. So, and what about only the fixed costs here, not the interest part? Only the fixed costs. By how much extent they have gone up? 47 from 40. From 40 they have gone to 47, which is 17.5%. So the fixed costs, just because of the operating fixed costs, the profits have gone up by 17.5%. When the revenue has gone up by 10%, the profits have gone up by 17.5%. And overall profit after tax, it has gone up by 23.3%. Because again, this company had another fixed cost in the form of interest. The second company has two types of fixed costs. One is the operating fixed costs. Two is the interest. These are the two forms of fixed costs which exist in any company. And if at all these fixed costs are present, the fluctuations in the profits are much more higher. Right? When you do well, your profits are increasing drastically. When you fall, your losses are also increasing drastically. So that means the risk of the company, variability increasing, fluctuation increasing is nothing but the risk is increasing. So any company which is having such a kind of a structure will definitely increase its risk in the overall space. But at the same time, there is a benefit that is going to come up. You see, both the companies, though they are the same across, you are finding that there is a difference at this layer, right? Probably you have to make things even more better for you. You can very well look at changing even on the downward side. If you look at changing it on the downward side, you will see that the loss will be higher when you have gone for a loan or fixed cost compared to you have not gone. Which means in good economies or when things are going well in your favor, the fixed costs will give you very good leverage, very good benefit. Whereas when things are not going in the favor, they may even lead to the bankruptcy of the company. This is the most important thing that we have to look at as far as this chapter is concerned. So operating leverage. So now when we say leverage, that 10 becoming 17.5. The 10% increase in sales in revenues resulting in 17.5% increase in the operating profit, right? Only that is the operations part. So a 10% increase in the sales resulting in 17.5% increase in the profit, that portion is what is contributing to operating leverage, because of the operating fixed costs I'm getting that increase, right? Whereas in this case, even the sales has increased by 10%, my profit, operating profit also increased by 10% only, which means there is no benefit. But because of this scenario, my operating profit has actually jumped to 17.5%. So that contribution is the measure of operating leverage. And from here to here increase, from here to here whatever the increase has come, it is nothing but financial leverage. Leverage coming because of the finance structuring. So in the leverage, we always break it into two parts. The degree of operating leverage, which is from this, let's say 10% increase in the revenues. From this to this, what is the percentage increase? That is the degree of operating leverage. Whereas from here to here, what is the increase? Is the degree of financial leverage, right? And from here to here is what we call as total leverage. So total leverage composed of operating leverage as well as the financial leverage. So operating leverage increases with fixed operating costs. The more are the fixed operating costs here, the more will be the operating leverage. Now let's see here. Probably if I make this 20 and 40 instead of 30-30, I make it 20 and 40. You are seeing that there is a 20% increase here. The same 30-30, the same total cost is 60 only, but high in the form of fixed costs is increasing my operating leverage and then further increasing my overall leverage. So the higher the composition of the fixed costs in my portfolio, the higher would be the leverage. Higher would be the leverage is when things are good, I will make a very good profit. When things are not working, I'll make very big losses also. So the financial leverage increases with the fixed financing costs. Fixed financing costs are nothing but debt and interest associated with them. So because we are talking of leverage being a risky process, right? Leverage means taking risk. But every business will definitely take a risk with an intention that it will get better compensated with a higher return. That's the intention of taking any higher risk. So what are the risks that could exist with the company? At the top, we are starting off with a sales risk, because We made an assumption that the sales are going up by 10%. In that example, sales going up by 10%. Why? But if they go down by 10%, there is an uncertainty there itself. To what extent I can see my sales going up by 10%, right? If the sales go down, my overall profits and operating profit, total profit, everything will go down. So the uncertainty that is existing with respect to the sales is what we are defining as sales risk. So the monitoring of the sales risk is very much necessary from a company standpoint, and there should be a monitoring very much about the operating earnings. Operating earnings is nothing but operating profit. In our exam parlance, we'll typically use the word earnings as a substitute for profits. So probably you can very well, these two are interchangeably used, right? Typically, when we say operating profit, operating earnings, both of them are one and the same. So uncertainty about the operating earnings. What does that mean? If the sales are up, operating profit is up. If the sales are down, operating profit has to go down. See, if I don't have many fixed costs, even if sales go down by 10%, even operating profit also goes down by 10% only. But if there are fixed costs, it means I have taken a building without much sales. The per unit cost on this building rental is very, very high, that I will get into losses until I cover my volumes. Right? So because of the sales risk, there is a possibility of a business risk occurring. Right? The result from the variabilities of the sales, expenses or costs going up. Even if the costs are going up, overall operating profit will get badly impacted. And the more the fixed costs are there as a part of the total expense, profits also will mount up, losses also will mount up, which means uncertainty in the operating profit will be much higher. And that is what we are calling as business risk. So the major things which are impacting us are, one, the demand for our products, which could increase the quantity, or which could increase or decrease the quantity which we are going to sell. The price, because these two form a part of revenues. Revenue is nothing but the total quantity into total price per quantity. So even if this is uncertain, quantity which I am able to sell is uncertain, or even if price is uncertain, the price at which I can sell, both of them are having an impact on my operating profits. And along with that, the input price, the raw material, the variable costs and fixed costs. Fixed costs probably they may not change for a shorter period, but at least the variable costs. If I have to purchase the raw material and now the raw material has become very costly, even that could have a big impact on my operating profit. So these are all contributing to the business risk. Basically, in this, from this step to this step, across all these, wherever the numbers can change, they are all contributing to our business risk. Because this is purely the portion of our business, our operations, the core of our business, right? What are the raw material costs and all? What are the machinery costs and all? Whatever are the core part of our business go in here. And this is the financing part of our business. How do I manage tax? How do I raise capital? It's more of the financing part of the business. So any uncertainty at this level, we call it as financial risk. Any uncertainty at the operations level, we call it as operations risk or a business risk in short. So compared to the operating profit, EBIT, what is the variability of your final profit? Earnings per share or profit after tax, whatever is the name you give. And sometimes we even use net income. What is the variability that is coming to your net income? Because net income divided by the total number of shares. or profit after tax divided by the total number of shares is nothing but your EPS. So that doesn't, anything you use, all of them resemble one and the same. Whether you call EPS or net income or profit after tax, let it be a comfort on one terminology being used. To what extent there is a change in the profit after tax compared to EBIT? Compared to this, there is a change by some extent. And that is what is purely because of financial uncertainty. This part is purely because of operating uncertainty, operating leverage, and this is purely because of financial uncertainties or financial risk. So things are well, the returns are higher. Things are not well, the returns are much lesser. That is where you are going to lose, and that arises. The financial risk arises purely because of usage of the debt in the capital structure. The higher the composition of debt, the higher is the uncertainty that is associated. So, how do I measure these? Simple logic. When we say degree of operating leverage, we just take the ratio of these two things. We divide this by this and call it as operating leverage, right? So, which means if the sales have gone up by 10%, by what extent my operating profit is going to go up? So, for 1% increase in sales, how much percent is the increase in operating profit? For a 10% increase in sales, operating profit has gone up by 20%. So, for a 1% increase in sales, by how much percent is the operating profit going to go up? So, probably around 2%. So, when someone says the degree of operating leverage is 2, it means for a 1% change in sales, there is a 2% change in the operating profit. Change. It could be on the higher side or it could be on the lower side. This is what we call as a degree of operating leverage. Right? So the percentage change in, if you look at the formula, percentage change in operating profit, EBIT, divided by the percentage change in sales. 20% change in EBIT divided by 10% change in sales is what we are calling as degree of operating leverage. So it will be higher if the fixed costs are much higher and lesser vice versa. Right? The other way of computing the same, unless see this formula I will use when there are two different periods, or like from this period to this period there was an increase by 10% in sale. So when I have two different periods, I can come out with that kind of a formula. But if I have only one, right, just here itself I want to compute. Let's say without using this data, right, without using this data, I want to compute just by using this and this. I want to compute the operating leverage. The simple logic is you look at this formula. Sales, or better thing is sales minus variable costs divided by sales minus variable costs minus fixed costs. Probably look at it like this. Yeah, this is there. So probably here it's not there. So sales minus variable costs divided by sales minus variable costs minus fixed costs. This is what is a direct, so which means this does not contain fixed costs. Denominator contains the fixed costs. So how do I operate it in this case? It is nothing but sales minus the variable costs divided by sales minus variable costs minus fixed costs. This is what is the degree of operating leverage. In the first case, it is 1 itself, whereas in the second case, it is 2. And that is what we got here also. So these are the two different ways. If at all there is a percentage changes given, I'll use a percentage change in operating profit by percentage change in sales. That is what I'll use as degree of operating leverage. And for degree of at or the other way I look at it is sales minus variable cost by sales minus variable cost minus fixed cost. Both of them will give me the degree of operating leverage. The same way, if I have to talk about degree of financing leverage, I will divide this by this. I'll divide these two things. So the final change in profit, the change in final profit after tax or EPS, all of them are one and the same. The change in the EPS or profit after tax or net income divided by the percentage change in EBIT, which means if the EBIT changes by 1%, the final profit after tax changes by 1.33%. Right? The other way again doing it the same here is nothing but EBIT minus interest, or probably you keep it as EBIT alone, EBIT divided by EBIT minus interest. EBIT divided by EBIT minus interest could give me this formula. So how do I do it? Probably if I have to execute it, EBIT in the in the second case, EBIT divided by EBIT minus interest 1.33. We have got it even through this route also. So whether it is the degree of operating leverage or degree of financial leverage, I can go with the two formulas. If at all I am having in a regular scenario, I can take it as percentage change in profit after tax divided by the percentage change in EBIT, or I can very well take it as EBIT divided by EBIT minus I. And for your information, EBIT is nothing but this. This is nothing but EBIT. Right? So probably you can very well write it as sales minus variable cost minus fixed cost divided by sales minus variable cost minus fixed cost minus interest. Either you can write it. So the questions wise you can have all these kind of combinations. So you just need to be comfortable in the usage of all these things. So there is a degree of operating leverage, there is a degree of financial leverage. And when we say the degree of total leverage, we are just talking about the multiplication between the two. Degree of financial leverage into degree of operating leverage, which is nothing but if we just multiply these two, the 2.67, and if you look at just dividing the final thing with the initial thing, final change in profit after tax divided by the percentage change in sale, you are getting the same. So the definitions wise, you just need to be comfortable. What is degree of total leverage and how is it linked with degree of operating leverage and financial leverage? And what is the kind of relationship you can build between these two, and what kind of formulas? One, with respect to percentage changes. Percentage changes, we are taking three things. One is EBIT, one is the EPS or net income, and one is the sales. Using these three, how do I build DFL, DOL and DTL? The second is if I just have one single column of data, right, only for the current year without talking about percentage changes, how do I find out DFL, DOL and DTL? Which is nothing but sales minus variable cost by sales minus variable cost minus fixed cost, giving us the degree of operating leverage. And if I include even the interest part, it gives me the degree of financial leverage. So if we have already seen what kind of impact does this financial leverage can have on the net income. The higher the financial leverage existing, we should be comfortable with the word. When we say the financial leverage, it is nothing but debt more. more of a debt, more of interest. So if the interest is very, very high, the net income wise, if when the market is good, the net income is growing much higher. If the financial leverage is much higher, we are seeing that the profit from this operating profit layer, the total profit is increasing by a higher amount. In the final net profit, net income is increasing by a higher amount. This has increased by 20%, whereas this has increased by 26% just because of this existing. And if this is even more higher, let's say instead of 10, let's say it is 20. You see that this has gone up to 40%. So when things are good, this will go very drastically high. But if things are bad, the same thing will be on the downward side. Even my overall loss will be by a bigger amount, a 40% drop in my profits rather than a 40% growth. So the swing could be the same either way. And if we look at overall, more and more debt I am using. Only now look at not in terms of the increase, but look at the actual structure. If I am increasing more debt, more interest, which means overall profit is going down. The increase in the profit is higher, right? You have to be comfortable with this. Overall, for a company where there was no debt versus where there was debt, because up to operating profit, both the companies are having the same amount. But because of the debt, this company's overall net income, probably I'll not use the word PAT because our exam terminology is net income, right? Or probably the US way of calling profit after tax is nothing but net income. So the net income is higher in case when there was no financial leverage versus when there was a financial leverage. The growth is also higher when there was a leverage. But overall, when you just look at, so these are the tricky, twisting kind of things you have to be comfortable with. The question could be the company has higher financial leverage. So what will happen to the increase in the net income when sales go up? Then it is increasing. The percentage is increasing. But when I look at the net income per se, it will be much lesser. Right? So it reduces the net income because the interest is going up. The higher the financial leverage means, higher the portion of debt for me. And the higher the portion of debt, it will increase the interest. And because of the interest, the overall net income is going to go down. And if the overall net income is going down, if the profits of the company itself are down, the retained profit will be even more down. See, what the company does, whatever the profit it is coming, it is getting some portion of the profit. It will give as dividends, which we will look at in our next chapter. It will give them as dividend, and the remaining portion is actually getting done as a retained earnings. And that retention is adding up as additional capital to the company. Now, if the final profit itself is very low, the retained earnings also will be lower, which means the net equity capital is also getting lesser. That is what we are saying. The net equity also goes down. Net equity, because whatever is the retention is going as additional capital. And if the retention is lesser, additional capital is also lesser. So the share of equity typically goes down. So when the most important ratio which people look at in the investment world is return on equity. One of the most important ratios that is being looked at is return on equity, which is being taken as net income by equity. And what we are saying is, depending on, and we are seeing both of them are going down. In this case, both of them are going down. So depending on which goes down heavier, my ROE can be either up or down. Right? Depending on whether the numerator is going down drastically or denominator is going down drastically, I will look at the overall impact on the return on equity. But when should I take more and more debt? If I take more and more debt, if it is really going to increase the value of the firm. What do we mean by increasing the value of the firm? The NPV is positive. Link it to your capital budgeting. If you remember, we made this statement. If NPV is greater than 0, we said that excess amount is going to add up the value to the firm. And how is the NPV calculated? By discounting with cost of capital. Look at this chain. Right? We are saying the value of the firm is increased if the NPV is positive. When will the NPV be positive? We are discounting it with the cost of capital. And cost of capital contains cost of debt. Right? So, if my cost of capital is lesser, there is a chance that NPV is higher. And because of that, there is a chance that it adds value to the firm and the business. So, as long as my NPV is going up, as long as the value of the firm is going up, we are fine adding up. And we have also seen that the more I raise in the form of debt, the cost of debt also goes up. We have seen the breakpoint calculation and all. The higher the amount that I am raising in the form of debt, the cost of debt is suddenly mounting up. And which means I cannot raise capital at the same rate beyond a certain limit. So what we are saying is, you raise the debt to such an extent, you do the borrowing or you raise capital in the form of loan to such an extent that your NPV keeps increasing. The moment your NPV is down, probably you stop going ahead with that. Now, one more concept that has been discussed in this chapter is the word called break-even. Break-even, when I see break-even is nothing but the minimum number of quantity I have to sell so that I get into a no profit, no loss situation. Assume a company which does not have any fixed costs. No fixed costs, no borrowing. Right? Let's say my business doesn't have these two things. What is my break even? Even a single sale I make, I'm profitable. Even a single, let's say today I started off my business with zero expense. No fixed costs, nothing. No loans, no fixed costs. If I have to just talk about the profitability of my business, the first customer whom I get, assuming my variable costs are lesser than the price which I have sold that product to that customer, my first sale itself is fetching me the first profit. Whereas when there are fixed costs in the business, right? Let's say I have a fixed cost of this building rent of 15,000 bucks. Right? Now, the first sale I have made, let's say 10,000 worth the sale. And for that my cost is 5,000. The cost of developing that or whatever it is, let's say my cost is 5,000. So my profit is 5,000 in that one single sale. But it will not cover my cost for the building. Unless I make 3 sales. Unless I make 3 sales minimum and get 5,000 profit from each of the sales, only then it is covering my fixed cost. Because whether I make a sale or don't make a sale, I have to make that 15,000 bucks payment for my fixed cost. Same thing holds true if I have a debt and an interest also. Whether I sell something or don't sell something, I have to end up paying for it. Correct? And that is what we are calling as the break-even quantities. How many minimum units I have to sell to make sure that my profitability is going to start. My all fixed costs are getting covered. So that's the reason. The simple way we compute it is nothing but the fixed costs, the total fixed costs, which means the total operating fixed as well as the financial fixed. So the total fixed costs divided by per unit sales, per unit sales minus variable costs, which is otherwise called as per unit contribution. As another term, sales minus variable costs is called as contribution. So we'll take it as the total fixed cost divided by per unit contribution. So let's go back to this example. Let's assume, here we have assumed that we had 10 units, right? So per unit sales cost is 10 million. Per unit sales is 10 million. Here per unit variable cost is 6 million. So in this case, what is my break even? I don't even have a fixed cost, and I don't even have operating fixed cost. I don't even have a finance fixed cost. Divided by sales minus the variable per unit. So probably if I'm saying sales minus the variable cost per unit, which is nothing but zero, because I don't have any other fixed cost. Whereas when I am saying in this scenario, what are my fixed costs? My fixed costs. So my fixed costs are 40 plus 20, 60. 60 are my fixed costs. So whatever the per unit benefit I am getting, it should cover this 60. Only then I am breaking even. Right? It should cover this 60. Now look at it. On per unit, how much I am going to get? Probably here, my per unit is 10 minus 2, right? Variable cost is only 2 here. Per unit, the variable cost is only 2 because I am taking it as 20. So what it means, at least 7.5 units I have to sell, because on per unit, I am getting 8 million benefit, but my fixed costs are almost 60 million. So at least 7.5 units I have to sell to break even. So the simple logic for us is apply this formula. If I want to find out the total break even point for me, look at the total fixed costs, not per unit, total fixed costs divided by per unit sales minus the variable costs, or the per unit contribution. Now sometimes people also talk about not the total break even, they only look at the operating break even point. In that case, only you take the operating fixed costs. Don't take finance fixed costs. When I want only operating break even point, take only the operating fixed cost. The denominator remains the same. Price minus the variable cost per unit, both of the per unit contribution itself. At least minimum of those many quantities have to be produced. So in this case, what is the scenario? Per unit. So I have to cover just this 40. 40 divided by 8. 10 minus 2. Which is saying at least 5 if I am able to sell. It will produce my operating break even. If I am able to sell 7.5 units, it will create my overall break even point. Right? So these are some of the things that are covered as a part of this chapter. Very small kind of chapter. See, typically the operating break even is looked at by the company because they are, that's the core of the business. See, financing, there is a possibility that the moment I bring in all equity capital, The debt part will go up. It's something external to the scope of the business. But if the business itself is not profitable, whatever the way I raise the capital, it will never be profitable. So that's where the companies look at, if the operating, at least if I am able to meet the operating break even, what the companies look at is probably will continue for some more time. Will continue for some more time, even if some volumes go up. Probably we may achieve even the total break even. Even today, if I am not achieving the total break even, in long term I may achieve. But if the operating break even itself is not getting met consistently, it's better to shut down the business. At least 1 year, 2 years you may wait, but you may not want to wait for a longer time because your business is not creating that profitability for you. So that's where people look at these two stages. Though overall it's better that I should meet my total break even itself, because that's what determines my overall profitability. But at least if the operating profit is started flowing in, probably by altering my capital structures and all these things, I can think of achieving the overall profitability, because that has nothing much to do with the business operation. It has more to do with the financing operations, which could be external to the firm to some extent, right? So overall break even as well as the financing, the operating break even are looked at, and exclusively financing break even will not look at, because it has nothing much to do in that context.